Okay, so the street's absolutely cheering what looks like a massive, logic-defying earnings beat from Salesforce today. But if you dig into the fine print, you realize nearly half of that profit came from a stock market paper gain, not actual software sales. Welcome to Earnings Unscripted. It's August 26th, 2026, and we're unpacking Q2 for Salesforce, ticker CRM. Miro, did they just pull a massive fast one on everyone?
They kind of did. I mean, the headline results look totally solid. Revenue landed around $11.3 billion, up 11% year over year, which comfortably cleared Wall Street's bar. But that earnings per share figure everyone's so excited about, that $5.90 non-GAAP print, that's practically a mirage.
A mirage how? Because the tape definitely doesn't think it's fake. The stock gapped up hard right after the close and settled up almost 13% in extended hours. Clearly, the market bought the narrative. And really quickly, before you go trading on Miro's cynicism here, please remember this is just our personal opinion, definitely not financial advice. So why are you calling those earnings fake?
Because the actual software business didn't generate that money. Look at the footnotes. Roughly $2.6 billion of that net income jump was strictly from markups on their strategic investment portfolio.
Wait, hold on. You mean their venture capital arm? They just took the private startups they own, marked up the equity, and passed that off as operational profit?
Yeah, pretty much. I mean, their non-GAAP methodology doesn't strip out unpredictable stock market swings. So if you back out that VC padding, their underlying operating earnings are incredibly routine. They essentially engineered an earnings surprise using a portfolio markup.
That's wild, but honestly, it worked perfectly for the story Benioff wanted to tell today. He came out swinging on the call, basically declaring the whole SaaS-pocalypse canceled.
Right. Well, he had to. Everyone's worried that AI is going to cannibalize per-seat software licenses. So he aggressively pivoted to this whole Agentforce narrative, pointing to massive adoption and claiming AI is an overlay on top of CRM, not a replacement for it.
And to be fair, they brought some great evidence for that. They talked about one massive digital platform using a dormant merchant agent. This bot basically lived natively inside Salesforce, generating thousands of daily interactions on its own to revive completely dead accounts. And it actually captured new revenue without a single human lifting a finger.
Exactly. The product vision is totally there, but the way they're calculating the growth for that specific Agentforce segment is, well, it's very creative.
Which is exactly what I want to untangle next, because I see they posted insane triple-digit growth for Agentforce, but there's this really quiet bullet point about redefining what actually goes into that bucket. I need to know exactly what they swept under that rug.
You said swept under the rug, but it's more like they repainted the living room and called it an entirely new house. They reported Agentforce ARR topped $1.5 billion, which translates to a 240% year-over-year growth rate.
Wow, that's a massive number, but given your tone, I'm guessing they didn't just sell all of that from scratch this quarter?
Right, because effective this quarter, they explicitly rolled Slackbot and a back-end data tool called Headless 360 into the Agentforce segment, so that triple-digit hypergrowth is heavily subsidized by tech they already had, just reclassified.
Okay, wait, walk me through that again. Are you saying Slackbot, like the basic chat integration people have been using for years, is now suddenly counting as an agentic AI sale? So they basically manufactured the growth spike on paper?
Well, no, that's slightly unfair to what they're actually building. They didn't just rename the old chat box. They've upgraded it to execute discrete AI tasks, which they measure as Agentic Work Units. The problem isn't that the tech is fake. The problem is they grouped an existing, massively adopted product under the new umbrella to make the AI adoption curve look vertical.
Ah, got it. So they folded a mature distribution channel into a new product line to mask the actual ground zero AI traction. It's brilliant marketing, honestly, but it makes you wonder how much of that top line is truly organic right now.
Yeah, and organic growth is exactly the thread to pull. They raised the full-year revenue guide, but M&A is doing the heavy lifting. Management confirmed they're expecting a contribution of $200 million just from the anticipated closings of Contentful and Fin.
Right. So out of $300 million total forecast raise, only about a third of that is organic. They're essentially dropping cash to buy those startups just to keep the top line pulse beating?
Exactly. And If you back out the revenue they're currently getting from Informatica, which contributed roughly $456 million this quarter alone, their true organic top line is barely scraping along in the single digits. Plus, they just baked in a new currency headwind, so the core business is definitely feeling the friction.
Which probably explains why they're so eager to transition top customers towards consumption-based pricing instead of per-seat licenses. They realize the old SaaS model is tapping out.
Yeah, this is where the mechanics of the business change completely. They're heavily pushing flex credits for AI tasks now. So instead of buying a license for a user, you buy credits and burn them down every time an AI agent resolves a case. COO Joe Milano even talked about customers refilling the tank.
Wait, that changes the whole equation, doesn't it? The entire premium of enterprise SaaS is based on predictable recurring revenue. If you move to usage-based credits, aren't they basically risking their own contracted pipeline?
That's the billion-dollar gamble. They're betting customers will burn through AI credits so fast that consumption revenue vastly outperforms the flat-rate licenses. But if those AI agents actually start doing the jobs of human employees, you won't need as many traditional seats anyway. So the real tension here is, can they sell enough AI credits to outrun the human licenses they're inevitably going to cannibalize?
Right, because if a single bot is suddenly handling the workload of several human reps, that company doesn't need to renew those seat licenses next year.
They're essentially racing against their own efficiency gains.
Exactly, and management seems confident they can win that race because they bumped the full-year revenue guide. They're now looking at a range of roughly $46.1 to $46.4 billion. But you always have to check what's under the hood of a race. Because like we mentioned earlier, a decent chunk of that top line is coming from pending acquisitions. The organic business isn't doing the heavy lifting here.
Robin Washington explicitly noted the organic bump is only about $100 million, and they're eating a new currency headwind on top of that. So Q3 is incredibly pivotal to prove this consumption model actually works in the wild.
And they really have to prove it because the long-term threat isn't just cannibalization. It's customers deciding they don't even need the software anymore. Like that anecdote from David Friedberg on the call.
Yeah, the weekend vibe coding project.
It's wild. His startup literally used Claude to spin up a fully integrated CRM from scratch in under a month. It proves their AI is powerful, but doesn't it also imply the traditional SaaS moat is evaporating?
That's exactly why Benioff came out swinging. He told investors this is the future of enterprise software, and I will tell you what it is not. This is not the SaaS apocalypse. But when your COO describes the pipeline by saying Q3 is math, Q4 is nearly math, it sounds like they're just coasting on momentum while they rewire the engine.
Q3 is math is officially my new favorite excuse for everything. But it paints a clear picture. They're making a massive pivot from renting software seats to selling automated labor. And those venture capital gains we talked about, they're basically buying Wall Street's patience while they make the turn. I guess we'll see if the market stays patient when the real usage data hits.
Always a pleasure. See you next time.
If you like having these quarters unpacked on your commute, go ahead and add us to your feed. For full transparency, this entire show, voices and all, runs completely on AI. That's how we pulled the numbers from today's massive Salesforce report and shipped this episode the very same afternoon. We'd love to hear your feedback or what ticker we should look at next, so shoot an email to earningsunscripted@datamadness.ca or grab the X link in the notes. Catch you later.
See you out there.